are still talking about the greatest story never told as we switch gears now from the economy to stocks. September stocks have been dynamite rather than a dud. Lower energy has greased the wheels. Internationally, Europe, Latin America, the Arabian Titans, and the Dow Jones World Index all registered solid gains this past week. Joining us now, Russ Kosterich of Barclays Global Investors and Craig Smith, Chairman and CEO of Swiss America Trading Corp. He's also the co-author of Black Gold Stranglehold. Wow, Black Gold Stranglehold. I have to start there, Craig Smith. What's the stranglehold?
Well, you know, for years, Larry, we've been held hostage to the dictates of foreign oil entities. And we bring forth science in our book that oil is not scarce. We're not running out. We just found potentially 15 billion more barrels of oil in the Gulf of Mexico. The head of Aramco the other day said we probably have 4.5 trillion barrels worldwide. Larry, we're not running out. And the people that are trying to
Peak oil. Peak oil. That is what you're basically saying is you're going to take peak oil behind the barn and just shoot it.
And I think we should, Larry. I mean, they've been wrong all along the way. They're wrong today. And look, I'm like you. I'm high on America. We have found natural resources here in America. We have great capital markets. Why don't we merge them together and lead the world on energy exploration and development instead of following the Middle East? It's ridiculous.
Russ, you know, the thought occurs to me we got about a kajillion barrels of oil on the outer continental shelf. We just had a little taste of it with this new find from the deep waters in the Gulf of Mexico. Yep. We got another couple of kajillion up there in Canada, which Western Canada I regard as pro-capitalism, part of the United States in terms of the oil sands. If we ever opened up the oil sands or the tar sands in the Rocky Mountains, Wyoming and Colorado, Russ, we could produce a ton, and I mean a ton, and that doesn't even include coal to liquid. Now, can we get to $45 a barrel, as our friend Chris is predicting?
You know, I'd probably put it a little higher than that. I'd put 50 to 55. I think you've hit upon a good point. We're not running out of oil. You've got plenty of hydrocarbons. But what has changed in the energy market is we're switching from conventional hydrocarbons to unconventional. And what that means is exactly the point you just raised. We've got oil sands. We've got coal bed methane. We've got coal to liquids. All of this suggests we have enough energy, but it's more expensive to produce. It takes longer to ramp up. And what that means is that you probably put a floor under oil because the marginal cost of producing a barrel's gone up. I put that at around 45 to 50.
All right, well, Craig Smith, I called you Chris. Please accept my apologies. Craig, you know, the basic consensus on Wall Street a month ago was 80 to 100, particularly with Ahmadinejad's saber-rattling and the Iranian story and all the rest of it. You know this as well as I do, Russ. You've been on the program many times before. 80 to 100. All right, now we're at, what, 62, 63. The chances are, from your forecast, of going to 45. You're not alone at 45, by the way. It's an interesting, there's a couple of outliers like yourself. So the question is, what's the timeline? Now, I don't mean specifically which minute of which day, but what events would trigger this continued decline in prices? Is it sales of oil floating on the high seas, which are in excess inventory? Is it speculators and hedge funds selling? How does this work?
Two things I think you...
Now, let me go to Craig first, then, Russ, I'll come back to you.
Sure.
Well, let me couch my comments by saying that I believe that an equilibrium price of oil is around $45 a barrel.
Is that that's from a lifting rate marginal cost? Is that what you're looking at?
Sure. I think that you need to have that price in order to go 28,000 feet into the Gulf to get the oil. I mean, that's what it's going to take to release the oil from the tar sands.
And at 45 bucks, more or less, this is kind of hard, but where do you put gasoline at the pump?
That's a very good question. It depends upon how we increase refining capacity. I suspect to be another 50, 60 cents lower than where it is now. But Larry, let me make a very important point here. We shouldn't underestimate this. While I'm very optimistic about the future for oil, and while on this very network just a month ago I was in that camp that said $80, $85 a barrel, we're two headlines away, Larry, from it reversing from 63 and going right back to 78. If Ahmadinejad continues this pursuit of nuclear weapons, if Nigeria has problems, if Hugo Chavez creates problems, I give you a number of different scenarios. You could easily see the oil run right back up because a lot of the price that you've seen is risk premium. It's terrorism premium.
I agree with that, but Russ, you'll take us out of this. I don't disagree with what Craig just said about the risk premium, the terror premium, but we've had a lot of monetary tightening. In the earlier segment on this program, we showed a bunch of charts. Money supply is completely dried up. The dollar, declining dollar contributed to higher oil prices. The dollar actually bottomed in late 2004, as I'm sure you know very well. And it looks like this is a roll down of commodities in general, Russ.
I think it is, but I guess where I disagree is that I don't think monetary policy is that tight. I mean, what really happened is the Fed has taken away those insurance policies they did in the wake of the bubble, in the wake of the corporate scandals, that really pushed real interest rates into negative territory.
Inverted yield curve. Inverted yield curve.
Okay.
High-powered money has stopped growing. Housing prices are deflating. Oil prices are deflating. Gold prices are deflating. The Ford Motor Company deflated 13% today, for heaven's sakes, Russ.
Japan still has 0% rates. ECB still at 3%.
All right, hold that. No, don't go there. Don't go there.
2%.
That's the next segment. I got a whole string of international questions for you on the very next segment. We're going to continue in just a moment on all the international stuff and maybe a little more about oil. All right, we're still here with Russ Kosterich of Barclays Global Investors and Craig Smith, Chairman and CEO of Swiss American Trading. Russ, go fast. Lightning round. Real fast. I want to pick your brain on some international headlines. This stuff is important. First, IMF. 5% growth in 06, 4.9, call it 5% in 07. Very bullish. You buy it?
I think a little bit high. If you look at the commodity prices, which have a good correlation with world GDP, I'd put it about 4.5%.
All right, that's still pretty solid. Now, swing over to Europe. A lot of talk that inflation in Europe is coming down. Their economy is not all that strong, and the 3% ECB Fed funds rate may not have to go any higher. You buy that?
I do buy that. I think maybe you're looking at another 25 to 50 bips. What this tells to me is Europe's a good buy right now. 12 times earnings, low inflation, low rates. So
you think they're actually going to go up 25 to 50 more?
I think 25 is not really pushing it that much. So to me, if they're at 3 or 3.25, it doesn't really change the story.
All right, Japan. Go to the other side of the world. Two quick questions on Japan. Number one, they produce some lousy numbers on machinery and business spending. And actually, their so-called great growth miracle ain't all that great. You don't think they're going to start raising rates, do you?
No, I don't. And that was actually to our point before. I think Japan's probably going to keep that zero interest rate for quite some time. But what you are seeing in Japan, which is a good story, is the banks are cleaning up their loan book.
Right.
And this is really the first time we can say this in better part of 2 decades.
All right. So is it fair to say the Fed is on hold? The ECB may be another quarter, although I have my doubts. Japan is definitely on hold. So the scares this summer about a global liquidity drain because all these big central banks will keep jacking up rates, that's gone. That scare is gone.
Well, it is gone. I mean, look at the bond market. You've got the yield on the 10-year going from 5.25 back in June to 4.75. The Fed fund futures market's telling you you're finished.
Right.
So the bond market, to my mind, is discounting this.
All right.
But, Larry, I think you have to also consider the wild card that China poses, given the fact that they are going to need huge amounts of resources to continue their boom over there. They're going to need plenty of energy, plenty of steel, plenty of copper. And so I'm not sure it's time to just pop the corks on the bottle just yet that this commodities boom is over.
Well, I don't know, because, you see, I think that all this is releasing a lot of pent-up demands over the past few years. I think that game is basically over. I think monetary policy has really tightened up in the Western countries. China is going to be affected by that also. I'm just saying moderation is the word here on a worldwide, which is tailor-made for stocks. Russ, here's the dumbest thing I read all week long in any newspaper on any subject. Shintaro Abe, who's going to succeed Koizumi as prime minister, wants to raise the Japanese sales tax. Now, that has to be the single stupidest human idea I have seen all week long.
1997, we all saw how well that worked out.
Can you believe that? It destroyed their economy. How stupid can this guy be?
Now, I think you nailed it. This is still a fragile economy. You've got to be gentle, which means low monetary policy and easy fiscal policy.
Russ, are you a bull worldwide? Are you a bull in the global market? Real quick.
I'm a bull on the global market. I think you've got some good opportunities. Europe, and I'd add Hong Kong to the list.
Craig, what's your take on the world energy story? One word, quick.
I think you need to be careful, that's all.
Yeah, I got a word for you, old buddy. Sell. That's my word. Russ Kosterich, Craig Smith, thanks ever so much.